Yield is a variable, not a signal. Most investors see a high yield and see an opportunity. The professionals see a high yield and see a crime scene. If you're looking at the number before the risk, you aren't investing. You're gambling on your own blind spots. In a market built on noise, this is structure, digital credit explained. In the previous episode, we completed our initial survey of the three instrument families: Bitcoin collateralized lending, stablecoin yield products, and Bitcoin treasury structured credit. We now have the vocabulary and the conceptual map in place. Today's episode addresses the single most important behavioral discipline in digital credit allocation: how to think about yield correctly. Not how to maximize it, how to interpret it. In every market cycle, across every asset class, there is a category of investor who confuses yield with value. They see a high number, a 12% annual return, a 20% APY, a preferred dividend that seems extraordinarily attractive relative to investment-grade alternatives. And they experience what behavioral economists call availability bias, the sense that the number itself is the relevant information. It is not. Yield is a derived variable. It is the market's expression of the risk premium required to attract capital to a particular instrument at a particular point in time, given the investor's assessment of probability-weighted outcomes. A high yield does not indicate an attractive investment. It indicates that the market, or the issuer, is pricing significant risk into that instrument. The question an institutional allocator must ask when confronted with an attractive yield is not, "How do I access this?" It is, "What risk am I being compensated to accept, and is that risk correctly identified and appropriately priced?" This distinction between yield as a number and yield as a risk signal is not theoretical. It was the defining failure of the 2020 to 2024 digital credit cycle. In that period, multiple platforms offered yields to retail and institutional depositors that were materially above anything available in traditional credit markets. Those yields were attractive. They were also, in many cases, structural warnings that were ignored or misunderstood. The platforms offering them were generating returns through mechanisms that combined opacity, leverage, rehypothecation, and insufficient collateral. Mechanisms that were either not disclosed or not understood by the capital deploying into them. The consequence was catastrophic. Billions of dollars of depositor capital were lost, not in speculative trades, but in what were presented as conservative, yield-bearing deposit products. The investors who lost capital were not irrational. They were applying a heuristic, high yield is attractive, that works in traditional credit markets because traditional credit markets have a long history of yield calibration, regulatory oversight, and ratings infrastructure. In digital credit at that stage, none of those calibrating mechanisms existed. This creates a specific imperative for institutional allocators approaching digital credit today. The imperative is this: yield is the last variable you evaluate, not the first. Before examining what an instrument pays, examine what an instrument is. Establish the structure. Evaluate the collateral quality. Assess the counterparty and the custody arrangement. Analyze the liquidation mechanics and the rehypothecation policy. Determine the regulatory jurisdiction. Only after that analytical process has been completed, only after you have a clear view of the risk architecture, should you consider whether the yield offered is appropriate compensation for that risk. This sequencing, risk architecture first, yield second, is the core discipline of what rigorous digital credit analysis looks like. It is also, frankly, the sequencing that this entire series follows. The series is structured to ensure that when we reach the yield episodes in Phase 4, the viewer has already spent months building the risk architecture fluency required to evaluate yield intelligently. There is a term used in traditional credit for this discipline: risk-adjusted yield. A risk-adjusted yield framework asks not, "What is the return?" but "What is the probability-weighted return?" accounting for all identified risk factors. A 10% yield on an instrument with a 20% annual probability of default is not in risk-adjusted terms, a 10% yield. It is a materially lower, possibly negative, expected return once the loss probability is incorporated. In digital credit, building that risk-adjusted analysis requires exactly the skills and vocabulary we are developing in this series. Yield without risk context is noise. Risk-adjusted yield is intelligence. The discipline that separates rigorous digital credit allocation from yield chasing is simple to state and genuinely difficult to practice consistently. Yield is evaluated last, not first. Every high yield is a question before it is an opportunity. The question is always the same. What risk am I being compensated for, and have I correctly identified and priced it? The investors who lost capital in the 2020 to 2024 cycle were not asking that question. This series is designed to ensure that the investors who engage with it always do. In the next episode, we introduce the architecture of the risk framework itself, the specific pillars through which any digital credit instrument can be systematically evaluated, and why each pillar matters. Clarity before yield. Always. Digital credit explained. Like and subscribe.